By the end of this video, you'll grasp why Fed Governor Lisa Cook's sudden warning about potential rate hikes could send shockwaves through global stock markets and impact the US dollar. As the SPY inches closer to all-time highs, are we witnessing the Federal Reserve gearing up for more rate hikes rather than cuts? Let's dive deep into the facts, market reactions, and macroeconomic implications. For months, investors globally have been operating under the comforting belief that central bank rate cuts were on the horizon. This optimism has fueled rallies in equities and risk assets worldwide. However, persistent inflationary pressures and a resilient economy are complicating the Federal Reserve's path. While official data shows some areas of inflation decelerating, subtle price pressures remain present in everyday life. Analysts warn that when central bank officials mention the possibility of rate increases, it signals that tightening monetary policy is still a viable option. Grasping this dynamic is crucial for understanding global capital flows. Diving into specifics, Federal Reserve Governor Lisa Cook made it clear she's prepared to raise interest rates if inflation doesn't show signs of cooling. This bold statement directly addresses the ongoing debate about future monetary policy. Simultaneously, equity markets have displayed remarkable resilience, with the S&P 500 ETF, SPY, recently hovering just 0.3% from its all-time high. This bullish trend persists despite ongoing concerns about potential tariffs, high interest rates, and significant corporate investments in AI. The stark contrast between the Fed's hawkish rhetoric and near-record stock valuations reveals a widening gap in market sentiment. On the social media platform X, market participants and analysts are buzzing with debate over these developments. Traders note how SPY is tantalizingly close to record highs despite the macroeconomic friction. Commentary highlights everyday inflation, pointing out instances where product sizes have shrunk while prices remain unchanged or even higher. On the political stage, posts feature former President Trump claiming inflation has dropped at its fastest pace in years, while employment has reached historic highs. These contrasting viewpoints illustrate the intricate intersection of real-world price perception, economic data, and political narratives. Institutional analysts and market strategists interpret Governor Cook's remarks as a clear indication that the battle against inflation is far from over. A hawkish stance from key Fed officials raises risk premiums across various asset classes. Experts stress that official inflation metrics often lag behind real-world consumer experiences, like shrinkflation. If central bankers view underlying inflation as sticky, timelines for interest rate cuts could be delayed or replaced with discussions of further tightening. As a result, institutional investors are re-evaluating discount rates and valuation models for high-multiple growth equities. For Japanese equities and international investors tracking Tokyo markets, signals from the Fed carry significant weight. A hawkish monetary policy in the United States bolsters high U.S. yields, exerting upward pressure on the U.S. dollar to Japanese yen. While a strong dollar benefits Japanese exports, rising global borrowing costs can dampen risk sentiment. Analysts urge global investors to closely monitor how currency fluctuations interact with central bank policy rates, as shifts in U.S. rate expectations can lead to volatility in foreign exchange and cross-border capital movements. Shifting our focus to currencies, commodities, and global spillovers, potential U.S. rate hikes are poised to strengthen the U.S. dollar, drawing global capital into dollar-denominated assets. This trend puts downward pressure on foreign currencies and risk assets worldwide. Interestingly, the on-chain financial infrastructure is expanding, even amidst macroeconomic uncertainty. For instance, Chainlink's cross-chain interoperability protocol now secures over $16 billion in wrapped Bitcoin value across major assets, commanding nearly 70% of the wrapped Bitcoin market share. This growth exemplifies how structural adoption in crypto persists despite fluctuating macro rates. So, what should individual investors do in this complex environment? First and foremost, avoid the assumption that rate cuts are a given in the near term. Second, keep a close eye on upcoming inflation reports and speeches from central bank officials for any policy shifts. Lastly, practice disciplined risk management. With stock indices like SPY trading near historic peaks alongside hawkish Fed warnings, chasing rallies without adequate risk controls can be perilous. Diversifying your portfolio, maintaining sufficient cash reserves, and prioritizing asset quality are prudent strategies in times of elevated macroeconomic uncertainty. Now, let's explore 3 potential future scenarios using our AI framework. In the bullish scenario, with a 30% probability, inflation cools rapidly in upcoming reports. Fed Governor Cook and others maintain current rates without further hikes, rekindling rate cut expectations. This could see SPY break above record highs, leading to a broad rally in risk assets. In the bearish scenario, assigned a 35% probability, inflation remains stubbornly high. The Fed acts on its hawkish warnings and raises interest rates, triggering a sell-off in equities, a sharp dollar increase, and pressure on risk assets. In the base scenario, also with a 35% probability, inflation gradually cools. The Fed keeps rates elevated for longer without immediate hikes or cuts, leaving equity markets range-bound near their highs as investors digest economic data. In summary, today's key points are as follows. First, Fed Governor Cook indicated a readiness to hike rates if inflation persists. Second, SPY remains resilient near record highs despite macroeconomic concerns. Third, investors should prioritize disciplined risk management as interest rate expectations shift. What are your thoughts on Fed rate policy? Join the conversation in the comments below. If you found this analysis insightful, please like and subscribe for more in-depth financial insights.